Hey, good afternoon, everyone. And can you guys hear me and see the presentation? If you're able to hear me and see the presentation, can you just let me know really quick in the chat box? Okay, perfect. Okay, great. Thank you so much. Awesome. All right. Well, thank you. And so good afternoon. And I guess we can go ahead and get started. It is 12 o'clock and we will try to be respectful of everyone's time. Welcome to the Sage Investing Group webinar. We're really excited to have you guys here today. Thank you for joining us. My name is Jen, for those who don't know me, and I'm a co-founder of the Sage Investing Group, along with Maggie and Lana. So just want to let you guys know that during the presentation, if you guys have any questions, please feel free to type your questions into the chat box and we will get to them at the end. If we should run up on time and we can't get to all the questions, rest assured that I will go ahead and compile everyone's questions and answers and send them out in an email to everyone after the presentation, along with a recording of today's webinar. Today you are joining us for a 30-minute session to kind of get you familiar with multifamily investing. I know for a lot of new investors, this topic can be a little bit overwhelming. So our goal is to make it as easy for you as possible. And so if you're new to this space and you're like in no rush, we welcome you to attend all of our bi-monthly webinars and to take your time learning and asking us questions. But we understand that everybody has their own pace and agenda. So if you guys have specific questions, or maybe you're further along on this investing journey, and you feel like you know enough and want to start investing, we're also here for you to answer any specific questions that you may have. And then we can talk a little bit more later if you are not in the investor club, how you can join and receive deals from us. So essentially our goal is to provide you with key information and how it would impact you as an investor so that we can help you make an informed decision when it comes to informed decision on whether or not this method of creating passive income and wealth building is the right choice for you. And most importantly, that when you come across a deal in the future, you would kind of understand what to look for in order to see if that particular deal would help you achieve your investing goals. So of course, today is just like a basic introduction session. So we will cover all these other topics in our future webinars. So before we jump into the presentation, I just want to briefly introduce myself to those of you who don't know me, so you don't think I'm a complete stranger. My world is essentially summed up by these two pictures. These are some of the most important people in my lives. They mean the world to me, and they're a huge part of my why. And they are kind of why I started exploring alternative ways of creating passive income and building my wealth in the first place. I wanted to do all that so that I can have the time and the means to spend quality time with them. I personally strongly believe that at the end of the day, our life is defined by the relationships that we make and I guess how much we are able to help others while we are alive. And so I'm pretty sure I'm not the only one that feels this way. And maybe that's why you guys are here today as well, because of your why and, trying to find a way to achieve that. So also wanted to say a little bit about our investment journey, our real estate investing journey. So you have a little background on that. So my husband and I, we have been investing in real estate since 2007. But we didn't really buckle down and try to scale until about 3 years ago. And we found that actually scaling on our own, it was pretty tough to do one property at a time for several reasons. One of it was that, where we live, I'm from Maryland, and where we live, it is pretty hard to find cash flowing properties, cash flowing rentals. So what made sense for us was, we had to drive an hour away to find properties that kind of make sense. So I ended up buying 2 duplexes in such an area. And so another reason why it was a little bit hard to scale for us was because, both of us have pretty busy careers. My husband, he's a full-time realtor, and I was working a W-2 job that was pretty demanding, and it was like an hour commute from my home. And the job was in DC, so it took me like an hour every day to get there, and an hour to get back. So that took up a lot of our time. And then, as you can see, we are raising two young boys. So they are pretty busy too with their activities, on the weekends and on the weekdays that we have to, that we have to chauffeur them to. Oops, sorry, hold on one second. So I guess, with our kids and our family, we're still trying to find time for each other, for our family, and for our friends, just trying to enjoy life, and not just always be so busy. So then we were introduced to this idea of passively investing in multifamily in late 2017. But like many people, we didn't really start because we didn't think it was right for us at that time. So we thought that, we didn't start because we thought that we wouldn't have control over our investment. And then the other reason why we didn't start was because we thought our return wouldn't be as high as if we, did it ourselves and managed the property ourselves. So now fast forward 3 years later, we have dealt with so much craziness at some of these properties that we purchased that, it would give any landlord nightmares. But I may be exaggerating. I'm sure it could have been worse. And not everything was as bad as it may seem, but some of it happened. Some of these things happened, I felt like, because we were so busy with our work that a lot of times we didn't have, we couldn't deal with these situations a bit sooner. So I believe in life that everything kind of happens for a reason. And every time something happened at one of these properties, it was money coming out of our own pocket or out of the profit that we had earned from before. So then, the idea of passively investing became more and more appealing and kind of started making more sense to us. So as I said earlier, I feel like everything in life happens for a reason. And so through this journey, it has opened our eyes and to investing in real estate in a way that really works for our lifestyle. And in fact, I believe this way of investing would serve so many other busy professionals out there. So much so that I've changed career in late 2000 and actually late last year, and have decided to dedicate myself full time to the Sage Investing Group. So today, we joined forces in 2020, so last year. And so today we have collectively 14 deals altogether, totaling over 3,000 multifamily units and with a portfolio valuation of over $350 million. And of course, this is in partnership with other people. And so in terms of our investors, we have now over 170 investors, verified investors in our Sage Investor Circle. And on Facebook, we have over 400 followers. I'm trying to merge our 2 pages right now. So there's a little glitch, but when you combine our 2 pages together, there should be over 400 followers on Facebook. So since we joined forces, I think it has been a very fascinating journey so far for us as the Sage Investing team. Our network has grown tremendously, and we feel so proud and privileged to be able to be working on this space, helping other busy professionals like yourselves take advantage of all the benefits that passively investing in real estate can offer. So now before we get started, I just want to say really quick that this is for your education only. The Sage Investing Group, we are not a legal, financial, or tax advisory firm. So if you guys have any specific questions about those, please be sure to consult your lawyer or your CPA. Now, are you guys ready? We're going to start learning about how multifamily syndication works. who are the key players in the syndication and what the potential returns are like. This is kind of some of the questions I get from a lot of new investors. So I feel like it's important to kind of cover this on our very first presentation. So without further ado, let's jump in. So this presentation, these sessions are for you if you have ever tried to invest in syndications before, but then ended up backing out. Maybe you've invested in syndications, but didn't feel like you know enough, or maybe you felt overwhelmed by all of the information that's out there. We get it. We definitely have been there. So let's start off by defining what exactly is a syndication. A syndication is simply a group investment involving two primary parties, the sponsor and the investors. These two primary parties, they pull together the resources together to purchase usually a pretty large real estate asset, like a multi-million-dollar real estate, a multi-million-dollar apartment building. So some of these resources can be things like capital, time, expertise, credit, network. And I guess as a busy professional, maybe you have capital, but you may not have a lot of time to invest yourself and to learn how to do it yourself. So by pulling together these resources, people are able to achieve a greater, get a bigger investment rather than investing one single family at a time. And so really syndication is great for anyone who lacks one or more of these resources, but know that they can leverage them from other people in order to ultimately get what they want, which is a piece of cash flowing and appreciating real estate. Now, at Sage, we like to look at value add multifamily opportunities and just want to explain what that is. So we like the value add multifamily opportunities because it gives us all the perks that real estate has to offer, which includes cash flow and forced asset appreciation. So what cash flow means is that, we like to look for assets that are cash flowing from day one. However, there's still room to increase profit and therefore valuation through forced appreciation. And so forced appreciation, some of you may wonder what that is. So in a multifamily syndication, it's pretty similar to a business in how it is valued. The value of the business depends greatly on how profitable it is. So if we're able to implement a business plan that increases the business's net operating income, then we're able to increase its valuation. So that's what forced asset appreciation is. And so we can usually increase that through property upgrades. So we upgrade the vacant units and we're then able to charge a greater rental fee for these units and thereby increasing the profit. Or we can also go in and look for operational inefficiencies and make them better so that we can decrease our expenses. So either increasing income or decreasing expenses will help boost up the NOI. And if we boost up the NOI, then we can increase the property's valuation. So therefore, forced asset appreciation. Now let's talk about the players. As you can imagine, it takes a pretty big team to pull together a syndication. You have people involved such as commercial brokers, property managers, mortgage brokers, contractors, lawyers, CPAs. The two main players that we're going to talk about today, number one are the general partners. You'll hear terminologies like GPs or sponsors or operators, and these are all referring to the general partners. These people, this is people like us. We play an active role in the acquisition of the property and the execution of the business plan. So as you can imagine, there are so many steps that are involved in the deal, before it gets presented to the investors. So as a general partner, our job is to go out there and meet with the brokers. We look at properties, we underwrite this, we underwrite the deals, we get the financing, we go conduct due diligence, and we work with lawyers to prepare the private placement memorandum, and we raise capital for the deals. And however, the job doesn't really quite end there because after acquisition, the general partners, some of them may serve as the asset manager when we work closely with property managers to execute the business plan and to communicate with the investors. And the property managers are the people who are like on a day-to-day basis, they're managing, they're renting out the property, they're managing the property, they're helping us carry out the renovations of the property. And then we also work, we work with the property manager to make up distributions. And we also work with the CPAs to send out K1s each year to the investors. So there are a lot of, roles that the general partner plays. Pretty involved. And that's why, as a business professional, it's hard to kind of do both. And then the other key player are the limited partners, also known as investors, the passive investors, sometimes, silent partners. And so limited partners obviously have a very important job too, because without the funding, a deal would not be able to close. So as a passive investor, when you invest with a syndicator, you would own a percentage of the property along with the other investors on the deal. And then as an LP, then you have very limited responsibility as well as a limited liability on the investment. The only thing that is at risk when you invest is the money that you've invested. If something happens with the deal, nobody would be able to come after you, after your house or after your cars or your bank account. So whatever you invested is all that's at risk. And then just want to mention really briefly that there are two types of investors. They are the accredited and then the sophisticated investors. The SEC has set up some regulations that we have to comply with, and they set up these regulations in order to protect the public. So they said, as an accredited investor, this is, how you're defined. And if you meet these definitions, then you're able to essentially invest in a lot more private deals because you have the capital to bear any risk that are involved. So I guess if a deal goes wrong and you end up losing the money, you have sufficient capital and sufficient income so that, you're not going to go bankrupt investing in these private deals. So their definition is that, if you're an individual, you should be making $200,000 in income for the past 2 years and expected to do so going forward. Or you and your spouse jointly together makes $300,000 in income. So there's that income test, and then there's also like a net worth test. So it's either or. So you can either make that much in income or you can have $1 million in net worth. So net worth is not including your primary residence. And then as a sophisticated investor, there isn't really a guideline for this, but essentially it means that you're able to make a sound investment decision. And typically we like to have sophisticated investors who are making $100,000 a year in annual income or have a net worth of $500,000 or more. Otherwise, we wouldn't really recommend these type of investments for them. So just to go into the limited partners a little bit more, as a limited partner, just to kind of show you how it works, you are buying shares into a limited partnership or a limited liability corporation. And these entities are formed to hold the asset. So when we acquire a new investment property, it is housed in either an LP or an LLC. These are pass-through entities. So that means that as an investor, you get direct ownership of the underlying asset. And you also get the pass-through tax benefits as well. So that's kind of the difference between investing with us in these deals versus investing in a REIT, for example. And when you're investing in a REIT, you're investing in a company that holds like multiple real estate assets. But when you're investing with us, you're investing essentially directly into that real estate asset. And that's why you get a share of the profit as well as the tax benefits. So then depending on how many shares you buy, that determines how the cash flows are distributed, how the sales profit and tax benefits are divided up between the investors. And so a lot of people want to know what kind of returns they can expect from your investment. So the returns will vary deal by deal, but typically you can expect two types of returns, one of which is a cash distribution, which is typically distributed on a quarterly basis. And it usually takes 6 to 9 months after a project has started for the cash distribution to start. And the reason why is because we got to get time. We got to give ourselves some time to start implementing the business plan and building up a pretty sufficient cash reserve before we can start distributing to the investors. It's always, the property first before profit, right? We also want to make sure that the property is operating and operating well before we start giving the returns to the investors. And then the second type is profit from sales. So let me see. So typically, I guess investment returns that we look for, you can expect returns between 7 to 10% cash on cash. And we look for investments that have a 5 to 6 year hold, which means that, when you invest in these deals, you should expect that your money is invested long term. Sometimes, the business plan may be a little bit longer to give us more time to, to hit these target returns that we are looking for. And then we also look for 2 times equity multiple in these investments, which means that by the end of that whole period, the investment should double during the life of the project. So really quickly, I want to give you an example of what happens when you an investment that's a $100,000 investment with a 5-year business plan. So let's say that you invest $100,000 each year. You should typically get, based on that 7 to 10% we talked about earlier, between $7,000 to $10,000 in cash flow returns. Of course, that's part of the projection, but sometimes things obviously can happen that we wouldn't have expected at the time of underwriting the deal to know about. For example, like COVID. Obviously that had a huge economic impact. And so, since we weren't sure like what, how that would impact the tenant's ability to pay, we therefore kind of held back on distributing during this on a lot of the deals during this past year, because we wanted to make sure that the business was sufficiently funded before we distribute to the investors. So sometimes that, things like that could have an impact on the cash flow return. And then at the end of 5 years, if this is a 5-year business plan, you should expect to get between maybe $50,000 to $65,000 in return from the sale of the property. So then altogether, that's a 2 times equity multiple, because you get a total return of $200,000 for your initial $100,000 investment. You get that initial investment back, plus $100,000 more in return from the cash flows and the capital gain. So that is essentially, I guess, syndication in a nutshell. If you guys have any questions, do please let us know in the chat. And while I wait for you guys to put in your questions, I want to share with you how you guys can participate in future opportunities as a limited partner. So if you haven't yet, please do sign up to join our Sage Investor Circle. There's a form on there that you can fill out. It's a questionnaire. It helps us to get to know you a little bit better. And then the next important step is to set up a call with us. You'll get an email inviting you to set up a call with us so that we can get to know you better. But as part of our circle, you will just get newsletters and other communications from us. But we won't be able to send you any deal opportunities until we have talked to you. So the Sage Investor Circle is good for anyone who's just starting out, whether you are new or you're a pro at investing, whether you're doing this on the side or you're doing it full time. And for people who haven't invested in a deal yet, or if you have invested so far in several deals, it's good for essentially anyone. And we're here to walk you through the investment process every step of the way. So if you guys have any other topics you guys want to see in the future, please feel free to email us at sageinvestinggroup.com. And let's see if we have any questions. Okay, let's see. I don't see any questions yet. But thank you, Barry, for your comment. I appreciate that.
Hey, Jen.
Yes.
This is Maggie. Maybe you can share, there's still a few questions that came through earlier before the presentation.
Oh, okay.
So
Great.
maybe you can, one of the question was, how can I get comfortable in investing? I think what they meant is, how can someone get comfortable in the first investment? Or maybe you can share some of your own experience.
How you can get comfortable? Yes, that's a really good question. And so you generally a great way is to obviously talk to other people who have done it before. And so we're here to help you with that. Getting to know the team is very important, and that's something that we're going to cover in the future too, like how to get comfortable in your very first deal. But getting to know the team, doing your research, there's so many podcasts out there and so many books out there that you guys can read and listen to. It's a great way to meet sponsors through these type of medium. So I think most importantly, just talking to other investors and just seeing how, what kind of experience that they've had investing in these deals, and I guess, we're here to help as well. So do you guys have anything to add? Oh, Maggie and Lana?
I'm sorry. So I guess one thing I would share is like maybe you talk about the team, like, and the other thing I will say is be kind of get familiarity of where you want to invest. Like there's different appetite for investors. So some investor would like to invest in bigger markets like Atlanta or somewhere that in Charlotte that they are known. Or are you comfortable? Are you one of those investors are comfortable on more tertiary markets? So that's something that you might have to think about in appetite. And the other thing the next thing you will probably think about is, what is the business plan strategy? Are you more in the appreciation, buying for the appreciation, or are you buying for the cash flow? And that will determine like and what kind of returns are you looking for. So obviously, if you're looking for area in Charlotte or Atlanta, those are really hot markets, your return is probably going to be a little lower. Versus if you're open to tertiary markets, you might find a little bit better cash flowing properties. So that's something to add.
Great. Thank you so much for that. It's always good to get different perspectives. I guess everybody, has different methods of going about it. And I see one question in our chat, and I know we're at 32 minutes, but I think this is a pretty simple one. It says, can you do a 1031 to use for investment cash? Yes, you can definitely do a 1031. Although there are certain requirements that for 1031, in order for you to 1031 into an apartment syndication, typically the minimum amount is $500,000, because there's a lot of paperwork, a lot of there's fees and stuff like that involved to be a partner using a 1031, and so they do look for higher an investment amount if you do that. But minimally 500,000. I know some group may even go up to $1 million for a 1031 exchange.
So just to wrap that piece up, 1031 is accepted. I think it's on a case-by-case basis. So if you do have a 1031 and there is a deal and opportunity that is open to 1031, I would recommend just reaching out to one of us, and then we can talk through it. And then we'll just make sure that we have appropriate guidance from legal counsel to make sure that we can set up the entities appropriately to make sure that is handled smoothly.
Yep.
So we're now at 12:29. I think there's one more quick question. The question from is, how many deals do you do per year, and how do you evaluate an area to purchase in?
In terms of how many deals we do per year, so last year we did 3 deals together, and that's because with the COVID environment, it was really the deal flow were much lower than we would have expected, but it was slower. So we did 3 deals together. And then in 2021, we would like to do more, obviously. So, depending on what the deals are like out there, what kind of returns, and, once we vet them, whether we think it's appropriate or not for our investors, we would share those with you. So ideally, we would like to share maybe like 5 to 10 during the year, more closer to 10 than 5, but it really just depends on, what's out there. And then how do you evaluate an area to purchase in? Maggie and Lana, do you guys want to take that one?
Yeah, sure. We typically look for like markets that are where there's promising like population growth, more renter versus owner ownership. So for example, we're in the market we're looking at right now, the renter population versus the owner population is 50-50. So that kind of show there's a pretty great demand for renters. So that's one of the things. The other things we look at is medium household income, also the medium home values. So home values are higher, that it's really hard for people who are buying homes. So they're more likely to rent, and especially just like student debt is also rising as well. So that's kind of contribute to the demand of the market.
Yeah, other key
yes.
metrics that we look for is that area growing in population? You know, one of the things that a lot of people are talking about is migration movements, especially with COVID. Where are those new markets that have previously been maybe ignored or took to the wayside? And prime markets like New York and San Francisco have always been the key areas that people have moved towards. But now we see the transition or reversion of that migration happening. So we also want to see where is that population moving towards? And then looking for, do we see growth in numbers there? We also look for job growth, any indicators, either current, existing, historical view of where jobs have been, and then following companies, key major employers or retailers in the area, seeing if they're also growing, because big companies have done their due diligence to identify markets that they know they see potential in. And so we kind of assess that, see where they're thinking, and kind of look at those as an indicator that the market has positive trajectory. I hope that answered your question. But I know we're just at time or just over time, so I appreciate you guys so much. Shoot us more questions if you have. Offline.
I'm on mute. Yes, please feel free to send us any questions at info@sageinvestinggroup.com, and we'll be sure to get back to you guys. But thank you so much, guys, for attending this webinar. We'll send you the recording for your reference, and we hope to see you again on future ones. Thank you. Take care.
Thank you, everyone.
Thank you.